Good morning, everyone, and thank you for joining us today. We are delighted to welcome you to our series of regional webinars dedicated to various ESG-related topics. And today's session will explore one of the key aspects of corporate responsibility. This is tax compliance and transparency. A quick note before we dive in. The session is being recorded and the recording will be available on the Sorainen website for anyone who would like to revisit the insights from today. As you may know, OECD guidelines for multinational enterprises emphasize responsible tax practices as a cornerstone of sustainable and ethical business. Enterprises are encouraged to go beyond merely following tax laws to the letter. Instead, they are encouraged to embrace both the letter and the spirit of the law, making sure that their actions align with the intent behind these regulations. This includes providing timely and accurate information to tax authorities, ensuring fair assessments, and minimizing the risk of tax evasion. Yet another important aspect is tax risk management. Corporate bodies are encouraged to include tax strategy in their overall risk management frameworks to establish policies, internal controls that reflect their views on tax risk. Lastly, transfer pricing and the arm's length principle supports balanced tax systems. Today's speakers will delve into these points and share further insights. Throughout the session, please feel free to submit your questions via the Q&A tool. We will address as many of these as time allows in our Q&A session at the end. So let me introduce our today's speakers and the agenda. Firstly, Evita Gosa, Environmental and Legal Director and member of the Management Board at Schwenk, Latvia, will speak on assessing tax from a sustainability perspective and how taxation is being used as a tool to promote sustainable practices and what this means for the business. After that, we will analyze ESG and transfer pricing from a global and local perspective. So Melanie Appuhn-Schneider, partner and co-head of WTS Global Transfer Pricing Services, and Edgars Hercenbergs, senior associate with Sorainen, Latvia, will dive deep into these topics. And as mentioned, we will have a Q&A session at the end. So thank you for being with us today. Looking forward to a valuable and engaging discussion. And now I would like to give a word to Evita Gosa from Schwenk.
Thank you very much. I would first of all like to express my appreciation for activities of Sorainen devoted to ESG and sustainability in general, meaning that it is really of utmost importance to look at these aspects not only from reporting perspective, but really diving in. And of course, tax and ESG matters are really critical, and we can't really consider any ESG policies complete without looking at tax perspective. A couple of words about myself and the company I represent. Schwenk Latvia is a cement, ready-mix concrete and aggregates producer. One might ask, so what is the cement lady doing here today, and why exactly I am presenting this topic? But of course, cement industry and is a heavy production industry, and we very well are aware of our impact on society, on climate and the environment, and we take great care of reducing our negative impact and looking how to promote and implement positive impact. Just one example, exactly today we are announcing our CO2 capture project we are going to work on within the next years, and with implementing it we will be able really to catch most of our CO2 emissions. And just to give you an impression about the scale of what it means for the country, for Latvia. So currently we produce approximately 7 to 8% of all CO2 emissions in the country. So we are serious about what we are doing, and I guess that's also the key reason why I'm here today. We also take care about raising the bar, not just inside the company, but also in the society at large, in business. And let me then dive indeed into today's topic. So first of all, really, we will once again review the issue of whether tax actually is part of ESG. Then we will review current regulatory framework when it comes to tax being part of ESG, if so, and also review, let's say, whether there are really compulsory requirements regarding that as part of ESG, and some examples of voluntary initiatives and frameworks regarding responsible tax practices. And afterwards, we will then finalize this topic with considerations when tax is or is not considered a material topic, if we look at it from the ESG perspective. So no need, of course, to discuss a lot the meaning of tax. It indeed is part of everything we do, all parts of life. Almost no business decision can be taken without considering aspects of taxation. And it has been acknowledged so by the United Nations, by different other international organizations, that of course tax plays a role with respect to sustainable development, and in particular also reaching or achieving the 2030 United Nations Sustainable Development Goals. Now that we dive in, so we really have to consider several aspects. It is not just about tax compliance, just paying, whatever needs to be paid, depending on the specific country requirements. But we really also need to review, same as with respect to other issues and decision-making processes in business, we need to take a look how we take decisions regarding tax. And by the way, there are interesting studies also regarding these aspects. For instance, how responsible other ESG practices, for instance, CSR practices, are related to tax behaviors of the company. And a link actually has been found, which states that the more responsible the company is regarding other ESG aspects, the less aggressive tax planning is in the agenda of that particular company. Also, there is a view and the concept of tax signaling, stating that or suggesting that tax practices can provide information on the overall quality of business, including any other ESG practices. Tax behavior and compliance have an impact on the outside world and also create risks, be it reputational or financial, from the outside world on the financial value of the company. So we are already moving towards the concept of double materiality, which we will then discuss within the context of tax more specifically a little bit later. And if we already start considering tax as being part of ESG, then we also have to take into consideration that ESG tax efforts should seek to, first of all, minimize these financial, regulatory, and reputational risks, and also promote accountability to stakeholders and society at large, and seek impact, in this case, minimizing negative impact and maximizing positive impact. Now, a very practical question arises then: how to incorporate tax in ESG policies? Because if we move on and look at the regulatory framework, ESG regulatory framework currently at the EU and also national levels, we find that the Corporate Sustainability Reporting Directive and then European Sustainability Reporting Standards, being, let's say, inalienable part of reporting with respect to the directive, that there are actually no standards or compulsory standards regarding reporting tax. And we find that what is being suggested, that if tax is being considered still a material issue which the company needs to report about or for, that the best or suggested way is usage of Global Reporting Initiative tax standard due to mainly comparability of ESRS and GRI standards, and also, of course, acceptance among policymakers and investors. And by the way, GRI tax standard is also the first tax standard when it comes to ESG reporting. Now, but here we really find ourselves in the situation that tax can or cannot be established or identified as a material issue. So if it is a material issue, then the choice is to use GRI standard. What is the first minus we see in this is that GRI standards in general mainly focus on the impact perspective, not the financial risks from the outside world on the company. So if we really want to review tax from all perspectives, then we probably usage of GRI standard is not sufficient. So this is still kind of the regulatory framework, which is in a way compulsory if tax is identified as a material topic. Then we still need to report about it. However, we know that also among sustainability professionals and also surveys, several surveys that have been carried out, it is clear that tax really is among those issues which are really not considered as key ESG elements or components. Of course, the biggest focus currently we see is on climate, also on diversity, inclusion, human rights issues, but tax is currently, I would say, an orphan within the context of ESG. But there are a couple of I would say good tries, good initiatives at the voluntary level. And so I have here mentioned a few of those. So, and interesting that we can divide them also according to the spirit of these frameworks. So one, let's say, set are we can describe them as voluntary disclosure-based frameworks. So they mainly really focus on disclosure of tax practices, tax compliance. And then the second set of such voluntary initiatives we can describe as behavior-based frameworks. So they mainly focus really on tax management, tax governance issues, on practices, how decisions are made. So when we come back to disclosure-based frameworks, then of course GRI is still to be considered really the most comprehensive one in the current environment or legal environment we live in this regard. Then there is one more initiative worth mentioning, and this is World Economic Forum's International Business Council's stakeholder capitalism metrics, within of which there is a tax provision also related to disclosure. But it can't be compared really with the comprehensiveness level of GRI, because GRI really covers or requires organizations to report their tax strategy by providing information regarding their approach to tax governance, control and risk management, stakeholder engagement and management of concerns related to tax. And it also requires organizations to disclose information about their revenue, tax, and business activities on a country-by-country basis. Whereas the stakeholder capitalism metrics tax provision only or mainly covers disclosure of total tax paid, tax remitted, and total and additional tax breakdown by country for significant locations. And here, of course, a game can begin, like what are considered significant locations and really like how much information has to be disclosed. Now, when we go to behavior-based frameworks, then there are two initiatives really worth mentioning. They're actually pretty similar in nature when it comes to behavior. However, I would really want to mainly focus on the most comprehensive ones in the sense that it really applies to all sorts of businesses, because the second one mainly focuses on tax behavior of or with respect to unlisted investments through external asset managers. So I will stick to the first one, the so-called B-team responsible tax principles. So what is B-team? So this is again like a voluntary initiative or let's say a group of business leaders coming together already more than 10 years ago when they made the decision that business as usual does not serve needs of the society and the planet anymore. And why B team? Because we know A team, but A team exactly means business as usual. So B reflects plan B. So what is then, let's say, an alternative or a better alternative when it comes to business behavior? So they started with other, we can call them sustainability, ESG initiatives in different business areas and behaviors. But here, then really, we would like to focus on the established tax principles. We can describe it as a framework that details what good tax practice should look like and sets a new benchmark for businesses to work towards practicing. And it is, let's say, the these tax principles, of course, are also available publicly on B-Team's website. And indeed, I encourage all of you who haven't had that opportunity yet to indulge in these principles. Of course, so I won't go into, let's say, all of these principles or let's say, try to quote them, but so they really cover three main areas. So approach to tax management, relationships with others, and reporting to stakeholders, and really focusing on tax behavior, tax governance within the organization. And I think even sustainability professionals and tax consultants coming together, I think, can make good use of these principles, or at least seek inspiration when it comes to one's own business and governance issues. Now, if we go back to the current regulatory framework and reporting according to CSRD and ESRS, so we discussed already that tax topic can or cannot be, or let's say should or is not identified as a material issue. And of course, on tax, we look, let's say, in order to identify it as being or material or not, we use the same principles. So the double materiality concept, so impact materiality of this topic, and financial materiality. And again, using, let's say, methodology, how to come to that decision. And of course, if tax is identified as a material topic as discussed, so it can be currently reported either according to GRI tax standard or any other, say, of these voluntary frameworks. But let's say, to summarize, it really, let's say, the conclusions to be drawn are that there is still way to go. That, as mentioned, GRI, yes, currently the most comprehensive tax standard, but still mainly focusing on disclosure, and that there are theories, for instance, also that let's say, whether or not disclosure actually helps also changing behavior of businesses. So, for instance, from a more aggressive and risky approach to, let's say, much more, let's say, peaceful and less aggressive tax planning. So, obviously, the perfect solution for tax standard within the ESG framework does not exist at this point of time. But in any case, we can inspire ourselves and use the frameworks, let's say, for improving our practices within our businesses. Thank you very much.
Thank you so much, Evita. It was really impressive to hear the insights, from a company that, as we have heard, produces almost 8%, so almost 1/10 of Latvians' CO2 emissions. And it's good to hear about your, serious approach towards ESG compliance, including tax-related aspects. I really look forward to the discussion at the end. I will use the opportunity to remind that the participants can, place their questions using Q&A tool, and we will try to address those. And now let's go to our another guest speaker, Melanie Appuhn-Schneider from WTS Global. I mentioned OECD guidelines for multinational enterprises in the beginning. I believe that most of the participants know that there are also more detailed guidelines from OECD on transfer pricing. And let's delve into this topic. Melanie, the stage is yours.
Yeah, thank you, Vitalija. happy to be part of this webinar here today and to say a few words on ESG and TP. And yeah, for the agenda, I will start to give an overview on how ESG may be considered for transfer pricing purposes. I will then set a focus to discuss the impact of ESG on financial transactions, and then to be followed by my colleague Edgars, who will look at the impact of ESG on the value chain for transfer pricing purposes. Yes, and to pick up where Vitalija introduced the topic, the OECD transfer pricing guidelines. So we have heard, and it is also our perception, that ESG is on the agenda of many executives of multinational groups. That being said, the interlink between ESG and transfer pricing is really only starting to be looked at. So for the time being, there is no guidance on ESG and transfer pricing, and that is true both when we look at the level of the OECD and also at a national German level. So earlier in September this year at the ITR Global Transfer Pricing Forum, which was sponsored by WTS Global as a lead sponsor, one of the key OECD policymakers said that they will only be starting to focus on ESG and TP in the next couple of years. So that implies that while we see that companies are striving to fulfill ESG criteria, which may have implications on the value chain and affect intra-group pricing, there is and there will not be any dedicated OECD TP guidance on ESG and TP in the near future. But it is supposed to come. So what does that mean for us? Absent any dedicated TP guidance on ESG and transfer pricing, we have to rely on the existing TP guidance and apply the criteria surrounding the arm's length principle and comparability analysis, which are stipulated in the OECD transfer pricing guidelines for multinational enterprises and tax administrations, the latest version of which was published in 2022. Yeah, and let's do a quick recap on the comparability analysis and the arm's length principle. So the arm's length principle is the international standard that OECD member countries agreed should be used for determining transfer prices for tax purposes. And as part of the arm's length principle, the taxpayer has to price transactions within the group as if they took place between independent parties. And for this purpose, a comparability analysis has to be conducted. The comparability analysis is also referred to as the heart of the application of the arm's length principles. And controlled and uncontrolled transactions, they are deemed to be comparable if none of the differences between the transactions that could materially affect the price or the margins, or if differences can be eliminated with adjustments are due. So the key questions then is, for transfer pricing purposes, does ESG affect the price or margin agreed in the group for intercompany transaction? And for this purpose, the OECD published a 9-step typical process that is to be considered for conducting the comparability analysis. So the individual steps, they are shown on this slide here. I will not dive into details, but it comprises the years, broad-based analysis of the taxpayer circumstances, intra-group transactions, internal comparable, available sources of information, the TP method, potential comparables, comparability adjustments, and interpretation. So if we look at 2 broad-based analysis of the taxpayer's circumstances, it includes also an analysis of the industry. We will see that when we discuss financial transactions, the industry will play an important role. That being said, on general, the steps most likely to be most important are 3 and 7, the intra-group transactions and the potential comparables. So if we look at the intra-group transaction, the comparability factors are to be considered is the functional and risk analysis. And within the context of the functional and risk analysis, the effects of ESG to be considered will also depend on whether the M&E applies a central versus a decentralized ESG organization. So is ESG controlled centrally? Are there costs incurred centrally? Is personnel in place that manages ESG centrally, and do benefits arise out of these circumstances that may then in a second step warrant a charge, or if it leads to IP, perhaps even a royalty. But I won't say too much on this point since Edgars will focus on the implications of ESG on the value chain with the focus on physical goods. I would like to spend the next 10 to 15 minutes on discussing the impact of ESG on financial transactions. And we go back again and start with the regulatory framework at an OECD level. So the 2022 OECD transfer pricing guidelines, they contain one chapter on financial transactions. This is chapter 10. It includes guidance on loans, on cash pools, guarantees, hedging, and captive insurances, all of which are typical intercompany financial transactions. But as already mentioned in the introduction, there is no specific information on the interlink between ESG and transfer pricing in the OECD transfer pricing guidelines, and hence can also not be found in Chapter 10 on financial transactions. Therefore, as explained in the introduction, the impact of ESG has to be assessed on a case-by-case basis in coherence with the OECD typical process for conducting a comparability analysis. And we will see that in particular for financial transactions, ESG may have an effect on the credit rating of M&Es. So let's take a step back before we dive into the details. So what are some of the factors from a transfer pricing perspective that are important and that have a significant influence on the interest rate for intercompany financial instruments? This includes, next to the credit worthiness, the issue date of the loan, the tenor. So is it a short term? Is it a long-term loan? Usually the longer the loan, the higher the interest rates. Rank and securities. Is the loan senior or subordinated? Is it secured or unsecured? Certainly the currency is an important factor, and there are other factors to be considered, like the type of the interest rate. Is it variable? Is it fixed? What's the repayment type at maturity or ongoing? And are there any specific prepayment options such as early prepayment? So all of these factors have to be considered when determining an arm's length interest rates, but the starting point is usually the credit rating. So what is a credit rating? Well, the credit rating, it measures the credit worthiness of a borrower or financial obligation, and it's essentially based on default probabilities. So low default probability translates into a high credit rating and vice versa. Important for us when we price intercompany transactions, a high credit rating will result in a comparatively low interest rates. So we are then usually in the investment grade category that we see on this slide here, whereas a lower credit rating found in a non-investment grade category will result in comparatively high interest rate. So let's put then the ESG layer on top. Issuers, they may be able to obtain financing more cheaply on the market if the financing is sustainable. And this is sometimes also referred to as the green premium or creamium. And this may explain why the key rating agencies have moved forward to develop measures to integrate ESG considerations when determining the credit worthiness of companies. And there are usually two options. So one is integrating ESG criteria into the existing rating based on financial results, and the other is introducing a new ESG rating alongside the existing rating. So let's have a quick look at the approach that may be applied. And I took one example here on this slide that is applied by Moody's. You can see that they developed a credit impact score to the right-hand side, which is an output of the rating process that in the end indicates the extent to which ESG factor impact the rating of an issuer or financial transactions. And to arrive at that credit impact score, you have the usual sector-specific methodology, and these are enhanced with issuer profile scores. As you can see, the issuer profile score, they assess the company's exposure to risk categories of the ESG dimensions, all three of them, environmental, social, and governance. And the results of this combined consideration is then translated into the credit rating and an ESG credit impact score. It is alphanumerical, and it provides for a scale that runs from 1 to 5, where 1 is positive and 5 is very negative. And I think this is also important to understand. So based on such methodology, so ESG can have a positive, but it can also have a negative impact on the credit rating, which is corroborated by an analysis that was one. So 20% of all the data points resulted in the ratings 1, 4, and 5. So the two extremes, with one being positive, 4 and 5 negative. So that would mean that the ratings are different compared to if ESG had not been considered. And you can also see that environmental and social risks, they more heavily influence or have a negative impact in comparison to governance considerations. So now, putting all of this together, what does this mean then for determining interest rates for intercompany financial transactions? Well, that depends, among others, also on which transfer pricing method is used to determine the interest rate for the intercompany financial interest rate. So let's suppose that we have a FinCo that has issued bonds on the market. One of the bond is a green bond, and it also has loans in place with external bank. And there are two broad ways to then determine the interest rate. So one is the internal CUP method or the cost of funds method. If the internal CUP method or the cost of funds method is used to price intercompany interest rate, the external interest rate may be used as a starting point, potentially subject to further adjustments to price the intercompany interest rate. So now, with regards to ESG, what are the factors that may have to be considered? Well, does ESG have an effect, and is there a public rating that integrates ESG criteria in the external financing? In the example, yes, for the green bond, certainly, but what about the others? Should any potential premium or a green premium, be it positive or negative, be passed on to the intercompany borrower. That also depends on decentralized versus decentralized organization. What are some of the initiatives and for what purpose are the intercompany loans used? In contrast, when the external cap method is used to price intercompany interest rates, the intercompany interest rate is determined based on database comparables, frequently bonds that are traded on the secondary market. So what are some of the factors to be considered? Well, do these bonds consider a premium or green premium? If yes, is this premium comparable to that of the tested transaction and ultimately also of the M&E for which the intercompany interest rate is to be determined? So rating agencies, they tend to argue, for instance, that industry differences, they are priced in as part of the credit rating, which would imply, based on this theory, that you rely on bonds of different industries to derive an intercompany difference, but different industries are likely to exhibit different types of ESG risks. So in the end, an ESG comparability adjustment analysis may be warranted to determine the impact of ESG based on a comparable reference group to determine the effect of the interest rate. So to sum up, effects of ESG on the credit rating of companies that can be observable on the market from this end, from a pure economic perspective, ESG should be considered when pricing intercompany financial transaction. Of course, to be checked what the effect is if the company would be at one of the extremes, 1 to 4 to 5. That being said, if and how transfer pricing guidance on ESG and TP, including for the specific case on financial transactions, will look like, that still remains to be seen. Thank you.
Thank you very much, Melanie, and for your, insights. And now I would like to pass the microphone to Edgars Hercenbergs from the Sorainen Latvian office. I understand that Edgars will share some practical examples to further explore this topic and impact of ESG on TP. Edgars, the floor is yours.
Thank you, Vitalija, and thank you also to Evita and Melanie for very interesting presentations on the ESG and tax topic. And I listened very carefully, and I wrote down some keywords which were used also by Vitalija, for example, beyond the letter and according to the spirit of law, to dive deep into this matter. Behavior, whether the ESG and tax, tax here is orphan or material issue, yeah, and that there is a still way to go, or as Melanie told, the impact is only starting. And in my presentation, I would share my view together with the knowledge I have acquired, and also in the process of some analysis of particular companies. You will hear the issue about the conceptual side of the ESG. And here I would like to point out that this time I will talk about the reality that just by opening the book of ESG in practice, we can make some more flexible framework for transfer pricing compliance. And this is my message for you, dear colleagues. And as you may see, the agenda is quite structured, and I would initially start with a conceptual issue for you, and then I will dive in the practical example which could help you to understand the case better and maybe see your issues as well. Okay, let's move on. To start with the cohesion between the OECD transfer pricing guidelines and ESG, I started simply by answering what is ESG and what is transfer pricing, and I found that the this G element, which represents the governance, and actually this is about economic contribution, which is also the profit, and it goes together with value chain, as you may see, and inherently it is about the business risks and opportunities which companies decide to take on, and which companies control and finance to fly in the market. And the same is for multinational companies. And as far as you know, multinational companies are regulated by transfer pricing regulations on international level as well as on the local level. This time I will concentrate on the Baltic framework. However, for you to know, how does value chain is connected with international taxation? As you may see, here is the point of OECD transfer pricing guidelines, and the story which international tax says is that, first of all, taxes must be paid in the country of the residence, and that principle of arm's length is applied, or should be applied in every case. The principle of arm's length means that profits should be attributed to and taxed in the country where the value is created, and vice versa. Yeah. And the thing what could help us to understand it, this principle better, we could divide it in two phases. First of all, we perform some functional analysis. Also, as Melanie told before, we are performing also the comparability analysis of the other comparability factors, and then we apply the transfer pricing method on this economic substance that we have delineated. So far, so good. Yeah, this is how international law works, and this law is implemented in the local jurisdictions as well as Baltics by taking into account its specifics. All right, the next thing and big well is business strategy. Yeah, which is the part of transfer pricing. And here I would like to describe you the scheme, and I also use the laser pointer. Yeah. So let's have a look. Different jurisdictions say this is Baltic region, which means Baltic countries, and some other European Union country or non-EU country. Yeah, and there are multiple business processes. Yeah, management, production, research and development, and financing, as well as marketing, sales, and logistics. You may see that transactional flow is that product or service is transferred to another jurisdiction, to another company, which actually then sells or serves in the market. Yeah, and here you may see that there are two elements: innovations and product marketing. Yeah, the thing is that these two features actually are for the market, so the sales are better. Yeah, and you may ask, what is the meaning of this business strategy for transfer pricing? And you are getting to the right direction. Therefore, you should at least start to think for transfer pricing purposes and answer to three questions. First of all, whether the business strategy you use is relevant. The second one is whether and which party implementing this business strategy will account these costs, and in case of success or not success, or let's say long-term issue as success in the business strategy, which what is the reasonable timing of implementation of that strategy. Let's move on with the risks. And again, I will use the laser pointer. The next issue in regard to risks is whether, for example, the strategy of innovation as well as risks inherent this business strategy stay within the manufacturer or R&D company. And the same is whether the risk of connected to the product marketing is transferred to the local sales company, or it inherently always was there. Therefore, OECD transfer pricing guidelines again asks us the question whether the risk affects the transfer pricing. The next thing and the last big whale before we go further are losses. And let me explain you shortly the, let's say, aggregated data of profit loss account you see now. You may see that this is a foreign affiliate company and Baltic company, any you like in Baltic, whether Latvia, Lithuania, or Estonia. And the years are 5 years, as you may see. Oh, sorry, 4 years. The attention here is on the following. You may see that costs of innovation are accounted abroad. The product turnover is quite high, and if we divided the years in separately, then we could see that the turnover is growing each year. Yeah. However, you may see that Baltic company faces some losses. Yeah. And here is the point. What is said in the transfer pricing guidelines. And there are two issues. First of all, tolerance of loss, whether a company will, were it independent, tolerate the losses in long term. And the second question, and this is more related to the transfer pricing documentation, whether those losses which company, multinational company has, whether they may be somehow explained or accounted by not disclosing these results as losses. As you will see in the next slides, I will explain it in more detail. And to continue with the second part of my presentation, I would like to conclude that for long-term transactions, which means sustainable issue of the transfer pricing as well, the business strategy and its costs, risks, including upward and downward outcome, and losses may affect the transfer pricing compliance outcome. And for you to know, they also may trigger the transfer pricing scrutiny from the tax administrations of Baltic tax administrations. But here's the good. Here are the good news I would like to follow with, and this is about how we could use in reality ESG in transfer pricing. Just as Melanie explained, there are also good elements in reality that may be used just right now. And I think that here transfer pricing as a part of the tax is not an orphan. It is really material issue and the reality. And to move on, I would start with the let's say some theory, of course, and thanks to Stefan Greil, who enlightened me about these new topics, how we could use ESG in reality for transfer pricing. And you may see here the nine factors, yeah, and each of them have practical background, and I will explain it shortly afterwards. And by using these factors, you may then delineate the company and its business and its transactions in at least three categories: low ESG impact, whether the company is only buying very environmentally friendly raw materials, but this is not enough, therefore it is only low. Whether it is driven, that means it uses some high technologies, but still they operate according to the standard business procedures, or actually company is only focused on ESG, such as car sharing, for example. And let's move on with this practical case study. And I would like to remain this example of the loss. Yeah, as you may see, that very simple, that still the product has this innovation and development issue, and the product sales increase every year, which is good. The risk actually materializes in the upward outcome, as you may see. However, there are losses which are accounted in the Baltic company. Yeah. However, there still is a light in the end of the tunnel, and therefore the analysis, practical analysis, and here you may see the comparability factors for comparability factors, exact functional analysis, says that okay, the group invests in a sustainable and very innovative premium product. The product is unique, yeah, and the contract allocates the risks of related to the business strategy, as well as its outcomes, as well as the which company accounts the costs related to that business strategy. However, our market is concentrated, and this premium product still requires some significant efforts to develop. Yeah, and actually that decreases the profitability in the local markets. However, there are some tools which may be used to mitigate the profitability through payment terms. I mean, working with working capitals adjustments. However, there are no similar companies with the business strategy, and the products are less innovative. Yeah, and let's move on then with the issue of these ESG factors. And here you may see that I used only 4 key resources: product value setting, customer relations, and sales and communication channels, as you may see. And the thing here is that we put that the product is recyclable. This is about ESG. Yeah, the product quality is maintained in the long term, and we improve the product all the time so that it is very sustainable. And we also worked with customers. We segment them to arrive at the best solution for the client or for the customer. And therefore, we want to expand our customer segment, yeah, so that we can reinvest the profits in these relations and the product. Yeah. And what is also important, that the customer always receives the information for the product sustainability, so that it understands and uses this product sustainable. The next thing is, what would be the functional analysis? And here is the point which I started in the beginning of my presentation. You may see here, let's say, only 3 functions, yeah, which is R&D, marketing, and sales. Let's say R&D function is performed abroad in and marketing and sales is performed locally in Baltics. And the cornerstone here is the integration of these functions in the business model by using ESG factors, which I explained to you earlier in the previous slide. And how it looks. The integration from the R&D and sales looks like that R&D company actually needs essential information from the sales and marketing to make a product marketing or product development study and to effect it. And vice versa, Latvian or Lithuanian or Estonian company also needs some information which is relevant to launch the marketing and sales function, so that this ESG cycle, which I explained you in the previous presentation, works. And therefore, if we have such a framework and this framework works in the reality, then for you, you may take two decisions. The first decision is, I do not use ESG in my transfer pricing. Okay, then most probably transactional net margin method would be applied. And then you will have challenges with comparative market data analysis, which is mandatory because you should substantiate these losses. All right. But if you use ESG in transfer pricing, you can say that so long as your control transactions are integrated and may not be split, to evaluate them separately, then you may also use another method which does not require market data analysis and allows to split the loss. And I'm sure you would ask me one question, Edgars, how to split losses? Yeah, and I would answer you shortly that at least in the three ways. First of all, you may split losses on contemporaneous basis. That means during the financial year, you may allocate the outcome as well as by taking into account the revenue and the expense. And actually, this could lead to allocation more of expense year-end basis. That means by the end of the year, you make some adjusting payment, which, as far as I know, is fine for Latvian regime as well as Estonian, but might be tricky for Lithuanian. And as far as I know, these year-end adjustments also are very detailed in Germany. And the third is after year-end basis. That means actually paying tax or facing the transfer pricing scrutiny and paying tax. I think that company may choose all of those three by taking into account specifics of each local jurisdiction, but they definitely work. And to conclude, you may see that Sorainen can help you to succeed with the analysis of value chain globally, locally, and how to put in transfer pricing documentation. This is not a theory. This is practical issue, as you could understand from my presentation. We can also verify that in reality ESG has impact on the value chain and transfer pricing. Or if you still want to be in this start point, and let's say follow the line and then maybe step in, and that means if you want to not to choose ESG usage and transfer pricing, we can conduct market data analysis anyway, which is challenging, but also for loss issues we can do it. And so far so good. I hope you enjoyed. And there are at least two words that I want to mention in the end. Contact us. Thank you.
Thank you very much, Edgars, and thanks, Evita and Melanie. I'm looking into the Q&A session. It seems that we do not have questions from our participants. I strongly hope that they are listening to this webinar while jogging or doing some other environmentally friendly activity. But still, I would not like to let our speakers go because the presentations were fantastic, very interesting, and I have a couple of questions for you. So first question, Evita, as mentioned, I was very impressed about, Schwenk's views and about integration of, ESG, tax compliance within the ESG, management framework. I would like to stress that I think that many companies do not even consider including tax into their long lists of the risks to be analyzed while doing the double materiality assessment. So could you please firstly confirm or explain if this is possible, and if not confidential, does Schwenk consider tax compliance as a material topic, and do you plan to disclose in line with CSRD and ESRS when the time comes? And another thing, when considering, whether the tax topic is material or not for the business, perhaps in your view, there are some red flags that should be taken into account and that could definitely lead to the conclusion that the tax topic is material for certain business. Evita, please, could you share your views?
Yes, thank you very much. Yeah, as mentioned, really, so far, I think companies have not taken tax so much into consideration when looking exactly from ESG perspective. So I think they of course, responsible companies do treat tax seriously, but let's say really not from this perspective. And honestly, I'm really grateful, let's say, for this opportunity to be here, because I also really indulged and I opened, let's say, a broader horizon for myself, and actually, having an opportunity then to use this also within the company, because we have not, let's say, treated tax separately so far as a material issue. We are currently actually exactly in the process of double materiality assessment within the group. So we are considering it. We view, of course, tax also broader. So, for instance, we are part of European emissions trading system. Of course, formally, it is not considered tax, but let's say if we look at it, let's say from a broader perspective, we can treat it as a carbon tax. So of course, it plays a critical role for us, and let's say for shaping our behavior. So and as mentioned, one thing is that we are responsible when it comes to management of tax inside the company. But of course, it is also critical that the country has fair, effective tax system. And that's where we also, as a company, participate. So, being part of, for instance, Foreign Investors Council in Latvia, in other organizations where we discuss with the public sector, and this is also dialogue and transparent, of course, dialogue. Again, having these conditions on this dialogue, and not, let's say, looking at this as a, some, let's say, that it is something like selfishly, for us gaining some benefit, but looking at it like really, how the tax system can be beneficial for the society at large, for climate, environment, really that the tax system also is used as a tool to promote sustainability. So we are reviewing, let's say, the tax inside the company and looking at it, even if it is not considered, for instance, material so far, strictly looking from the disclosure, let's say, directive perspective, we are considering it, and we are planning certain, like we can say that we have a tax strategy in that sense, and we let's say we have principles, which we apply within this framework of how is our tax behavior, and we can really, we could name examples on how we, I would say, even not have just a conservative view regarding tax, but even probably a step further. We are really taking tax responsibly, because we understand that we are we are all united, we are all connected, and if we selfishly, try to do something aggressive, it is just a short-term thinking, and it won't, let's say, have any like further benefit for all, because we are part of the society, we are just a corporate citizen, but we are, we have links to other parties. Now, when it comes to red flags, I think that really currently we have these frameworks through which we can review what is considered as red flag, because indeed we live currently at times where it is not just compliance, like I pay what I need to pay and I don't care about anything else. So first of all, it is this co-responsibility of trying to build the effective tax system together with the public sector, but also thinking really, like how the decisions are made within a company, who is responsible for this decision making, that these decisions are being taken responsibly. And let's say this GRI tax standard, or B teams, like behavior-based standard, can be taken as a good example, to review if currently our behaviors maybe are not consistent with the best practices at this point of time, because society at large, different stakeholders require already more than mere compliance, because compliance is something that we can still play with. There are always, spaces for interpretation, and let's say if there is this kind of aggressive mindset, aggressive planning mindset, you can always, go this way and try to, use this interpretation possibility. So I think really applying goodwill, if we have already this sustainability mindset, then we will, find these opportunities to make these responsible decisions. Unfortunately, of course, if we don't have that mindset, tax is still an issue where one can play around. And especially in Latvia, we really we are hard fighters against shadow economy. I'm also, let's say, personally leading shadow economy combating work group in Foreign Investors Council in Latvia, because we see, what damage is being done by shadow economy. So of course we start with this kind of primitive, even, compliance issue. We are still fighting with that in the country, but we also have to look much further. That those players who are already compliant, how they also can improve their tax behaviors. Thanks.
Thanks a lot, Evita. Yes, and it was really interesting to hear, and I'm confident that Schwenk will be the one that will be leading by example. And also I would like to voice once again that it was very interesting in the beginning of your presentation. You mentioned some study that showed the link between overall responsible business behavior and tax compliance. And you were saying that, the more responsible the business is overall, on a wider perspective, the less aggressive tax planning practices such business apply. So very interesting. But now allow me to ask Melanie one question. So Melanie, as you explained nicely, ESG, well, should be considered when pricing intercompany transactions. We do not have a special tool for that. We use existing tools, existing TP guidelines. But could you please elaborate a little bit on this impact of central versus decentralized ESG organization on this TP? You mentioned that during your presentation.
Yes, sure. I'm happy to. And I think, the central versus decentralized ESG organization is probably easiest to understand when we look at the topic of the impact of ESG on the value chain for physical goods, also which Edgars touched upon in his part of the presentation. So the question really is, centralized versus decentralized. Do you have, one leading entity within the group, so perhaps the parent company that is, driving the main initiatives with regards to ESG? That could be on the product side, for instance, to invent new sustainable products. And then the question is, in order to develop these new sustainable products, may this give rise to new IP, perhaps, within the group? And then for transfer pricing purposes, we then have to analyze which is the entity that drove the initiative, which is the entity performing the control over risk function, and which entity should get the return. So it may well be then that ESG may lead to new developments, hence result in new IP. And if these are centrally driven, if costs are centrally borne for such purposes, this may then give perhaps rise to a royalty that is to be charged within the intercompany group. So you can look at the product side, you can look at the sales side, managing side. So there are many different ways within the functional and risk analysis that could play a role for such purpose.
Yes, thanks a lot. Thanks a lot, Melanie. And we have a very interesting question in the chat, which I will voice. And I would like then ask Melanie, Evita, and then Edgars to wrap up on this particular question. So our participant is asking, thanks for the insightful thoughts. The pressure on taxpayers is clear. ESG, fair taxation, and OECD guidelines apply for tax administrators as well. What is your suggestion to remind them on their share in this respect? I have the impression that tax authorities is still working around old reflexes, like filling state budget holes, reaching annual revenue goals, etc. I'm interested in your thoughts on the above. Thanks. So what's the role of tax authorities? And let's start from Melanie, if you may.
Yeah, what the role? Ideally in the future, we will have additional guidance on how to apply ESG, especially with regards to transfer pricing purposes. So I do believe that it is on the radar of the policy makers. I just believe that at this point in time, they're still in the process of finalizing some ongoing initiatives, but I would be hopeful and also positive that in the future we will have guidance on the effect of ESG and TP. Because we already see it is being discussed in the tax literature. It is a topic that we see at international seminars, and the more the focus is on the area, there will then also be increased pressure to release a regulatory framework to rely upon.
Thanks, Melanie. I'm happy that we are here, one of the pioneers in the region, I believe, to discuss about this topic. So, Evita, and what are your views on the role of the tax authorities and on their current, understanding of the topic?
Yeah, very, very good question. And I actually have real positive things to share. I think it is really critical, that we just don't say, that we don't like something, but we act on that. And one example is really participation in business organizations. And again, if we go back to, like any standards, this is cooperation with stakeholders, involvement of stakeholders. And of course, tax authority is the key stakeholder, or let's say one of the key stakeholders. And so in case of Latvia, it is of course also Ministry of Finance, for instance, and then probably broader government. But so the positive thing I want to share is that, of course, it is also important who is the head of that particular authority, because very much really depends on individuals. I mean, also, like be it management of the company, for instance, or always the head is the head symbolically. I mean, is really plays a decisive role on where we lead our organizations. Because we are the leaders and we can decide which direction to go. And I would say that in Latvia things are improving, especially if we're looking to the tax authority in particular, with the new head of the authority, because the new head is really interested in serving the society, serving businesses, and really keeping in mind, like why this is being done. And of course, there needs to be more understanding within the authority. The bar has to be raised in this regard. But one very particular example, and of course, this is also a very transparent process. Again, mentioning Foreign Investors Council in Latvia, which is an NGO formed, let's say, by businesses, let's say, with foreign investment in the country. We actually have a monthly format of meeting the head and the broader team of tax authority, depending on specific topics, and we are discussing different issues, including ESG elements as well, because of course we have new types of businesses, new types of companies, we have new challenges when it comes to climate, again, like different taxes, levies, and so forth. And they have to be governed in a way which really corresponds, to modern requirements. And yes, the process is relatively slow because the institution is big. The employees are how they are, but the drive is there. And I think it is really critical that we cooperate, we explain, we discuss, we even fight a little bit, like in a very polite manner, of course, but that we are discussing and we come to conclusions on very different areas. So therefore, always, engage, act, do things. And this is really helpful. Again, it takes time. It takes time, lots of time, but things are improving.
Thanks a lot. Edgars, have you had a chance to discuss some ESG-related aspects with the tax authorities so far, or maybe you are looking forward to such discussions in the future? A couple of minutes for you to comment.
Yeah, thank you. I would start with the issue of the concept, as you, I hope, remember that actually ESG in reality works for transfer pricing, and it actually gives you the flexible area. And in my example, I showed that even in case of loss, you may mitigate this risk. And if you have made a good homework, and you can make evident every point in your concept, then you are good. And actually, you should not be afraid of any communication then with the tax authority. Yeah, and the communication is then the next part. My experience is that Tax Authority of Latvia. Yeah, I'm Latvian. I'm passionate for transfer pricing, starting from the Tax Authority times when I was there. And I'm convinced that Latvian Tax Authority collaborates with the companies who are compliant. The next thing is whether we can get some certainty on Baltic, or let's say Baltic Nordic level. And as far as I know, tax authorities meet together to tackle how to avoid tax disputes further, which is a good sign. And I hope it will be continued. And there are also some good elements in Latvian and Lithuanian regime that company may ask to launch advanced pricing agreement process. That means in Latvia, for example, you could have 10 years of tax certainty about your price of control transaction. And soon I hope it will be the same in Lithuania. It is not in Estonia, but in Latvia and Lithuania it is. Yeah. Also, there are some issues whether actually the colleague asked about actually pointed out that TA is still working around old reflexes, and I would say, and this is actually the question I received yesterday, whether there are some ESG audits or ESG related audits. If we talk about loss as a sustainability issue, and we can interpret that this is some issue of governance, then yes, 5 million in transfer pricing audit in tax. So there is a reality about that still old reflex, but this is upon the fact that company in that case most probably was not prepared. And audits are only in case when the tax authority has promising case. Yeah, they will not go into the audit currently according to this framework. They have just for checking something. Yeah, therefore I would urge the companies and those attendees who still listen to prepare your concept, be confident about that, and do not afraid to communicate with the tax authorities of Baltic states because they cooperate.
Thank you very much, Edgars. And thanks to all participants and to our speakers. Sorainen is really honored to host those regional webinars, and we are really happy and thankful that local and international market participants eagerly share the valuable insights, their experience. If you have any questions, feel free to turn to us. Thanks again and have a nice day.